This analysis report makes a very aggressive bullish case for SoundHound AI. It focuses on Q3 revenue, the Amelia acquisition, and the central question, is Sound really the next Palantir? So let's dive right into that. The core theme running through this whole thing is that comparison. SoundHound to Palantir.
Right.
And it makes a pretty strong conceptual case. It talks about the operating system moats.
Yeah, the lock-in.
Exactly. Palantir locks in government data. SoundHound locks in automakers and restaurants. It's a really powerful idea to build on.
It is. It's a great hook. But I think, while that narrative is compelling, the analysis kind of relies on it too heavily. To really land the investment case, it needs to get into the economic mechanics, not just the idea of lock-in.
Okay, so you're saying the comparison is a bit surface level right now.
I think so. It establishes they both create a moat, but it doesn't really show us how SoundHound's business model is copying Palantir's playbook.
The playbook being?
Well, the nonlinear revenue scaling, the pricing shifts, the capital efficiency, all the things that actually defined Palantir's transformation into a profitable company.
That's a really sharp distinction. So it's not just a shared philosophy. It's about a shared structural path.
Precisely.
So the gap here is that the report needs to shift this from just a theme to a real economic argument. It needs to link SoundHound's moves to Palantir's actual success metrics.
Yes. You need to show the economic mirror, not just the conceptual one.
Okay, so let's make that concrete.
Let's ground it with the Amelia acquisition. The report says it bought the enterprise market.
Right.
Okay, but for that Palantir comparison to really work, we need to see the parallel. How does Amelia actually increase, say, the average contract value, the ACV, or the ARR? And does it do it in a way that's like what Palantir did when it moved from those small government pilots to massive decade-long enterprise contracts?
Ah, I see. So is the key difference here between like a high-volume licensing deal you'd see in auto and the deep, high-value enterprise integration that Amelia brings to the table?
Exactly. Is there evidence that SoundHound can now charge for the integration itself, not just for usage?
Because that's how the contract values explode.
That's how they explode. If Amelia lets them push ACVs into the multi-million-dollar range, that proves the model is shifting. That's the first step to nonlinear scaling, because you're adding huge chunks of revenue without a linear increase in sales cost. If they're just selling small licenses, then the Palantir analogy, it just doesn't hold up on the economics.
Okay, building on that, what about capital efficiency? I mean, Palantir was famous for optimizing its cost structure, right?
Right.
They got to profitability faster by managing their R&D and their sales and marketing spend. Is SoundHound doing that?
That's the other side of the coin. It needs to be explicitly discussed in the report. We need to see tangible proof that the paths are, as the report claims, identical.
So if R&D and S&M are becoming a smaller piece of a rapidly growing revenue pie.
That's a huge validation of the thesis. Right now it's implied, but it's not quantified. And without the numbers, the comparison feels more like an aspiration than a structural reality.
Okay, let's move on to the financials then. The report, it correctly highlights the big headline figures.
The 68% growth, yeah.
That 68% year-over-year revenue increase and the big EPS beat. They reported a loss of 3 cents versus 9 cents expected. I mean, these are powerful signs.
Undeniably. It supports that narrative that they're slashing losses while growing fast. But, I wonder, while those numbers are critical positive signals, does the financial breakdown give us enough context to really validate that path to profitability? My concern is that by focusing so narrowly on the highlights, it kind of leaves the reader with an incomplete picture.
So the worry is that the 68%, it's a composite number, and we don't know what's really driving it. Is it the core product or is it the acquisition?
That's it exactly. A really robust financial assessment has to clarify that. Is it organic growth or is it just acquisition-driven? And without data on, say, gross margins or their cash position or changes in OPEX, that claim of slashing losses feels more qualitative than quantitative.
Investors need to know if the engine itself is getting more efficient, not just that we bolted on a new part.
Right. So to fix this, the recommendation is to integrate those operational metrics. Give us a holistic picture of the company's financial health, not just the top-line wins.
It's about showing that the growth is actually sustainable.
Absolutely. If a big chunk of that Q3 revenue is from Amelia, the analysis has to state the percentage of organic growth. Sophisticated investors need to know that because organic growth tells you if the core voice AI product is actually gaining traction on its own.
And we need to go deeper than just revenue. So introduce year-over-year data on what? Cash use in operations or gross margins changes?
That's the real operational lever. Revenue growth is great, but if those revenues aren't yielding higher gross margins,
Meaning the cost to deliver the service isn't dropping as volume goes up.
then the business is just getting bigger, not fundamentally more profitable per unit. If you can show that more of each revenue dollar is turning into gross profit, or that the cash burn rate is truly slowing, well, that's much stronger support for the profitability claim than just an EPS beat, which can sometimes be, influenced by one-off items.
So what we're looking for is evidence that their cost of service is dropping as they scale. That's the classic move of a platform company on the path to nonlinear growth.
That's the ultimate proof point. If they're not showing that margin expansion, the growth story starts to look a lot less sustainable. We need to see that leverage being pulled.
Okay, let's shift gears a bit. Talk about the overall packaging of this, the delivery.
The tone, yeah.
It's very high energy. It uses this sharp, trading-focused language. Loading the boat, or $10.80 is your golden support zone. I see what they're going for, a confident, decisive style.
And that's a valid approach for sure. But I think that really aggressive, bullish tone, it risks alienating more sophisticated readers.
How so?
Because it fails to provide a balanced risk assessment. The weakness here isn't just about style, it's about analytical rigor. When you're projecting 135% potential upside for a stock, and there's zero discussion of counterarguments or market risks, it weakens credibility. It starts to feel promotional, not analytical.
But doesn't adding a risk section just water down the conviction? The reader is here for the bull case, right?
Not if you do it correctly. You can integrate a section that constructively addresses the main risks. It actually strengthens the argument. It shows the analysis has stress tested the downside and still finds the upside compelling. It adds rigor without sacrificing the bullishness. It shows you've done the homework.
Okay, so if we are going to stress test this, what are the most immediate threats to the SOUN thesis that need to be in this report?
I think there are two primary ones that directly challenge that moat concept we talked about. First is customer concentration risk.
Ah, yeah.
The analysis leans so heavily on big automaker partnerships like Stellantis and Hyundai. What happens if one of those contracts is scaled back or, worse, discontinued? That lock-in is only as strong as the next renewal.
That's a huge point, especially if a big chunk of that 68% growth is tied to just a few key players. That's a massive vulnerability.
Exactly. The second one is competitive risk. How does SoundHound keep its edge against the giants? Google, Amazon, Microsoft.
They're all in this space.
They're all in this space, and they're constantly advancing their own voice AI. They can leverage infinite capital and existing relationships to compete aggressively, especially in that enterprise market Amelia is targeting. If the tech advantage narrows, that moat shrinks fast.
And we should probably extend that balanced view to the technical targets, too. That high confidence in the $10.80 golden support zone needs a counterpoint.
Just for context. And more importantly, when you establish a technical support level, explain what would invalidate it. What kind of operational failure would break that support?
So you frame the analysis not just as a map of opportunity, but as a guide to vigilance.
Exactly. It transforms the trading call from a simple promotion into a sophisticated, two-sided tool for the reader.
This is, an incredibly high conviction report. The core thesis is really solid.